The Money Show.
Personal Finance with Warren Ingram.
Personal Finance brought to you by Satrix. Invest in global funds. Invest with Satrix. Warren Ingram, what an astonishing turnaround we have seen, not only in the fortunes of the JSE in the last couple of days, global markets generally, but of course our currency too has made a remarkable comeback.
It's been lovely to see. I feel like over the last 5 years, I've spent my time talking about, that the JSE didn't have such a bad day, or the Rand didn't absolutely blow out. So it's been lovely for the whole of November to talk about things that are positive. Markets going up and the Rand looking really good, and lots of good news stories to talk about. It's almost like a new country.
Long may it last. I mean, how do we make our retirement savings last longer? Because in an environment where returns have been as appalling as they have been, and where inflation has corroded the value of money over time, you've got a limited resource, a limited pool of cash. It's not going to grow by any other way other than through market movement and some smart investing. You can't really add to it because you're retired already. How do you make it last?
So I just want to give a little bit of context to people who are retired. I have lots of these conversations. It feels like endlessly, and I really understand why. When you talk to a retired person, they complain bitterly about their fund manager or their advisor, and then they phone me and ask me, if their advisor is particularly useless, or is all the fund managers in South Africa useless? And lots of people will have a view on that. But over the last 5 years, the average balanced unit trust, which is pretty much how most retirement money will be invested, they've delivered about 4% a year. So if you've been just in a fairly normal middle of the range balanced unit trust, you've been getting 4% a year. And as you say, inflation's definitely not been running at 4% a year over the last 5 years. And so I understand the issue, but it's important for retirees to not lose faith that what happened over the last 5 years will now become the norm for the next 5 years and the 5 years after that. That's called recency bias. It happens so often that the psychologists actually give it a name, and that what that means is that we project the past as if that's what our future is going to be forever. And unfortunately, in good times, the good times never carry on, but fortunately, in the bad times, they also don't carry on. So my first piece of advice is, please don't now move to cash. Cash is such a horrible return at the moment. You'll be really lucky to get somewhere around 3, 4, or potentially 5%. If you're really spectacularly lucky on most of your cash returns, and that'll be what you could expect over the next year or two. And a lot of retirees will do that. A lot of retirees now will be saying, I can't take the ride of the stock market anymore. I can't take these ups or downs. I'm going to go to cash. At least I can't lose anymore. At least I get some kind of a return out of that. And I think that's going to prove to be a really poor decision. And I'm not just saying it because the first few days of November have been good. I'm saying it because markets move in cycles. And this is potentially the end of a cycle globally, not just in South Africa. And if that cycle turns and it goes in the favor of emerging markets, which is my big kind of expectation of the next decade, then you definitely want to have exposure to shares in general. And that means, don't jump out of your balanced fund now. Stay in the balanced fund, because that's how you get your exposure to shares. So that'll be my biggest comment to people that are looking for some kind of preservation of their capital and then growth again. You can only get the recovery and the growth that you should have had over the last few years if you stay invested in shares, because that's where the growth comes from. So don't jump out now. One that really worries me, and it's a tough one, and I don't really have a clear answer, is what do investors do if they've been in income generating assets like listed property? Because unfortunately, listed property over the last 5 years has lost you 13% a year. It hasn't been in a flat line. Most of it's been in the last sort of 18 months. But that's a really difficult one, because I think a lot of those companies, to lose half of their value, which some of them have done over the last year or so, it's tough to recover that in a short space of time. So there, I would say, maybe look at trimming your position if you've got a big position in listed property.
Because listed property was the dead certainty. If you're going into retirement, you want to be in listed property. It's giving you capital growth every year. You're seeing the value of these companies rise and rise. They're growing. They're adding properties. They're growing their businesses. They're paying you a return. They're giving you cash on a regular basis. And they're giving you, in some cases, 100% of their earnings. I mean, it's a marvelous, marvelous asset class. until you have a pandemic and nobody wants to pay their rent anymore, and then all hell breaks loose, as we've seen.
And I actually remember sitting in a presentation by one of the big property managers 2 years ago saying, retirees should just invest their whole living annuity in listed property. You get all the inflation protection possible. You get income that grows faster than inflation. It's just a no-brainer. And anyone who doesn't do that's kind of an idiot. And I was one of those idiots that wasn't doing that. And I was really worried that I was missing the boat. And, I feel for those retirees that would have followed advice like that. It's just, you have to, maybe that's the other piece of advice in something like this, is you have to spread your assets across all of the main asset classes, in other words, cash, bonds, property, and shares. And don't be too specific in saying, I'm only going to be in shares, or I'm only going to be in cash. That's a sure way to lose money over time. You have to make that spread. And then the last piece of advice on that, with this kind of situation is be careful of allowing the amount of money you draw from your retirement funds to increase too much. I think the withdrawal rate, if you're relatively young, and for a retiree, I'm saying somewhere around 55 to let's say 70, you need to have your withdrawal rate somewhere in the region of 5 to 7% at the most. If you're 55 and you're drawing 8 or 9% a year from your capital, you need to understand that you are sure that your capital is going to deplete because that's quite a lot more than the inflation rate, and it's very hard for assets to give you inflation plus 8% a year. That's just a very tough target for any asset class to deliver that. And no matter how good you think your fund manager is, that's going to be very tough to do. So it might be a case in these times when we are getting a bit of a break from inflation to actually cut your expenses if possible. And I know that's a very tough thing to do, but what you don't want to do now is let your expenses run away from you early on in your retirement when it's still possible to make changes. Because if you need to make changes at age 80 and you're now drawing 20 or 25% from your capital, that's tough to recover.
It's so important, Warren. I mean, it's so important. You don't want to be, condemning people to a poverty mindset when they've worked very, very hard all their lives and have saved so much money and they've done so well. But the risk of spending too much and sort of trying to maintain a high-flying lifestyle as you retire and just trying to keep on as if nothing's ever going to change is high risk. It's a high-risk life strategy because you don't know how long you're going to live, and you certainly don't, but you can project how long your money is going to last based on how much you're taking out. And if you are subjected to a long life, particularly a long and unhealthy life, because as you get older, your risks increase, of course, of not being particularly healthy, you run out of money and then you become somebody else's problem. And that is your problem too.
I can't agree more, but hopefully it's a long and healthy and productive life. And I think one of my comments of hope here is, and it's, hope is not an investment strategy, but just to emphasize the point, what's happened in the last 5 years is almost 100% certain not to repeat itself in exactly the same way in the next 5 years. And so that, that's really the point to understand here is, if you've been invested in balanced funds or just a general balanced portfolio and you've had lousy returns, don't think that that's the future forever. The likelihood is I'm looking at a lot of fund managers now who are starting to be really much more guardedly optimistic about the returns from shares in South Africa over the next 5 years than they were 5 years ago. And that for me is always a great indicator that the cycle is starting to turn in our favor again. And listening to some of the international fund managers as well, who have no skin in the South Africa game, they're looking at our markets and starting to say there is opportunity there, and we need to we need to look at it more closely.
And then finally, one that we shouldn't have to repeat, but we do. Don't get scammed. Don't be greedy. If it's too good to be true, it already is. We've done that one. It's important. We have to say it. I hate saying it because I think people should know better, but unfortunately the data suggests not. In a moment, I've got a question, and that question, Warren, I'm not sure if you've seen it, but how much should I save every month to stop working as soon as possible? How long's a piece of string? I don't know how we tackle this particular question, but I've just given you the hospital pass, and we'll get to that hospital pass with Warren Ingram from Galileo Capital in a moment.
The Money Show.
Personal Finance with Warren Ingram.
How much should I save every month to stop working as soon as possible? Question came through to us. So, how much, Warren? Give me a number. Exact number.
Well, you're asking a financial planner how much you should save every month, and the answer is always going to be, save as absolutely much as possible. But I think that doesn't help a heck of a lot. So I think that there's a range, and to me, at the minimum, you should be aiming to save at least 15% of what you earn every month. In other words, before tax, so what your company would call cost to company, so if you work for a business, then 15 Rand out of every 100 you should be aiming to save. So that might include a portion of the money that your company is deducting to be paid to your retirement fund, but then you need to top it up. And to me, that's the very least that someone should save. And what you need to know then is that you're saving so that you can retire at the age of 65. You won't be able to retire earlier than that unless you play the lotto as well and you happen to be one of the one in however many million that actually win it.
13, I think. So one in 13 million Rand, 13 million chance was the last time I looked at a number one of those. So, yeah, your odds are quite small of winning the lotto. Some people do. But
they do. Yeah.
I know a guy who won a lottery once, and it cost him a fortune later on in life. But yes, anyway, that's another story for another day.
Me now.
I know. Sorry, carry on.
So I think on the other end of the spectrum, the classic super saver Julia story that we've talked about many times on the show over the years. If you want to reach financial independence and you want to do that long before the mandatory retirement age, then you're looking to save at the very least 33 Rand out of every 100 that you earn on a monthly basis, and that's every month of every year. And I think that's probably a good optimal range for most of us. There are extraordinary people out there that might save, 50 or 60 Rand out of every 100, and well done to them, and that's great. But I think for most of us, there needs to be a bit of life while we're working and the like. We can't just save everything. And so I think a good range is that 15 to 33 Rand out of every 100.
And if you think Warren is mad and smoking his socks and you've not come across Super Saver Julia before, go to facebook.com/Bruce Business. Just go Super Saver Julia, or just Google Super Saver Julia. And we've talked about her many, many times over the last 7 or 8 years. And she continues to be a massive inspiration to lots of people. And she managed to, a third for tax, third for spending and fun, overseas trips, dinners out, groceries, car, petrol, house, life. And then she had kids, but yeah, that's when things come a bit unstuck from a financial planning perspective. And a third put away, and she did it when she was young. And as a result, she has a very, very nice base from which to work. I
agree. And I think the big trick there is don't give yourself an excuse not to save. I think so. Once you start on this, if you're determined to get to that financial freedom age, whenever that is, depending on how much you want to save, then that's got to be the goal that you give yourself. And the reasons not to save have to be eliminated. You have to say to yourself, I'm prepared to trade off. I'm prepared to trade off whatever it is that's not that important to you for that financial freedom. And for me, I have photos in my office here of places that I want to go and visit. The holidays I want to take. And so I'll give up other things that are not that important to me to keep going on that on the dream and the holidays that I want to do and the travel I want to go on. And so that's the thing. You've got to find the thing that's going to motivate you and help you kind of make those trade-offs. I'd hate to call it a compromise because it's not. You are going to live a great life, but you have to be methodical about it. You have to be determined. And you can't just let life happen to you. I think that's the issue I find with this. Okay. Is a lot of the time people say to me, Warren, you've spoken about the super saver, but, and that but is always the excuse they are giving themselves to not save. It's the reason why.
You put but in the middle of a sentence and you are already looking for an excuse. I mean, it's a universal truth on absolutely every level. I'm not a racist, but I want to say, but, I mean, all of this nonsense, but immediately negates everything you said just before that. We need a word. We need a phrase. We need a piece of terminology or a wisdom or anything, really. The 5% rule. I've chosen this one. What is the 5% rule?
The 5% rule to me is the golden rule for trying to decide how much you need to be able to stop working one day. And so 5% is the amount that you can draw from your capital safely so that you allow your capital to grow and beat inflation, but provide you with an income. And so just to give you a really practical example, if you if you draw, let's say you're going to live on 100,000 Rand a year. I know that's not a realistic example for most, but just to say that. So you're going to live on 100,000 Rand a year. That 100,000 Rand needs to be 5% of the capital that you've got at your financial freedom age or stage. And so a very simple way to do that is you take the 100,000 Rand, and I'm actually doing it live while I'm talking to you, so live radio, it's very exciting. And you say, well, okay, great. So I've got my 100,000 Rand a year, and I divide that by 5%. And that tells you need 2 million Rands worth of capital to be able to fund your 100,000 Rands worth of expenses. What that will do is if you invest in a typical balanced portfolio, and we've just been talking about that, over time, and I know that hasn't been the last few years, but over time, typical balanced portfolio will give you somewhere around 10 or 11% a year of growth. And if you're drawing 5%, that means you're leaving behind 5 or 6% a year that stays invested, that gets reinvested in the portfolio so that you beat inflation. And so that is the 5% rule. It's a very nice way for someone to do a sanity check on their own savings, their own capital, without having to go and do a big complex model, or if they're worried that their advisor's telling them a big story, they can do this for themselves once a year. And I always do this to check the big financial models that we build in our business, and check that that I'm still on track, and that's what my wife uses to keep me accountable for our savings and investment strategy.
Fun night ahead at the Ingram House. Warren, thank you very much indeed. But an important night. Those nights are important. Warren Ingram, thank you very much. Personal financial advisor, executive director, Galileo Capital, travel enthusiast, good life enthusiast, savings and investing enthusiast as well. Every Thursday night here on The Money Show.